172,000 jobs. That's almost double what Wall Street expected. And on that news, stocks fell, bonds fell, gold fell, and Bitcoin fell all on the same day. Roughly $2.5 trillion of value just gone, evaporated, poof, on a good number. Why? Honestly, because the biggest IPO in human history is about to vacuum all that cash right out of the market. SpaceX, $1.77 trillion, and your own 401k is about to be forced to buy it. Welcome to Funds on Fire, the podcast that ignites the passion of investment funds and capital raising. Here we turn the complexities of fund management into clear, actionable steps that drive results. I've invested into diverse real estate across the United States and managed thriving funds, and I'm committed to transforming lives through the vehicle of investment funds and helping others to do the same. Join me as we document the journey of scaling businesses, raising capital, and impacting tens of thousands of people around the world. My name is Devin Robinson, and welcome to Funds on Fire. Now, this episode is brought to you by FundFlow OS. It is the autonomous operating system that finds, nurtures, and closes capital for real estate operators. Flow AI is the employee that you can't afford yet in your company, and that's okay. It runs your investor outreach, drafts your follow-ups in your voice, tracks your 506B relationships for compliances, and does it all on this multi-model AI stack, which matters more than ever this week, especially with the week that we had, because two of the biggest AI companies on the planet just filed to go public. The vendor wars are about to get really, really loud, and the last thing you want is your entire firm married to one provider's roadmap. So if you guys are interested in checking out FundFlow, you can use the code FIRE for 50% off your first 3 months. Just go to fundflowos.com to check it out. Or if you're like a flipper or builder, just want to manage some of your investors, it's free to start. Really great. So check it out at fundflowos.com. Now, story number one, the economy did a really good thing and everything fell at once. What the heck could that mean? And Friday morning, the May jobs report dropped 172,000 new jobs. Wall Street was looking for somewhere between 80 and 88,000, more than double the estimate. Unemployment held at 4.3%, wages up 3.4%, and the prior 2 months got revised up by another 93,000 jobs. By every normal rule of the last 15 years, the market should have gone up and skyrocketed. Instead, stocks fell, bonds fell, gold fell, Bitcoin fell, all on the same day. One creator on Instagram summed it up with a number that got 688,000 views in one day. $2.5 trillion wiped out on a Friday on good news. And why did everything fall together? There are two reasons. And the second one is the one that nobody on TV is going to be explaining to you. Reason number one is the obvious one. A jobs report this hot kills the rate cut. The whole market has been priced for the Fed's next move to be a cut. This report flipped that on its head. The bond market moved from pricing a cut to pricing a hike. The odds of a rate hike before the year just jumped about 68% in a single afternoon. The 30-year treasury went right back near 5%, higher rates, lower prices on everything. This is the first reason why. And the second reason is the one I want you to really hear. There is a liquidity vacuum forming right now, and its name is SpaceX, Anthropic, OpenAI. And here's the mechanism. These three companies are about to go public, or they just raised a ton of money at a combined value north of $3 trillion. To buy into the biggest IPOs in history, funds and retail investors have to raise cash. And to raise cash, they sell what they already own. They sell tech, they sell crypto, they sell gold, they sell their dividend stocks. They free up dry powder for this skyrocket that's about to happen. And that's the conversation happening all over finance Twitter this week. One analyst put it quite simply, markets didn't just crash on the jobs report. The strong jobs number was the trigger, but the giant IPO is actively draining liquidity as funds sell positions to participate. So you had two forces hit in the same day. Rate cut dies. There's no hope of that really. And the biggest cash vacuum in market history switches on and sucks all the capital out of the market. That is why everything fell together. Now, why does this matter to a fund operator or to anybody that's investing in this space? Because a liquidity vacuum is not a threat to you. It's a gift. When everyone else is forced to sell and they're forced to be a seller, scrambling to free cash up, the operator who already has committed capital and a calm hand is the buyer of choice. Forced sellers create discounts. You want to be the one with the wallet open when they all show up. And let me make the rate side concrete, because higher for longer is an abstraction until it lands on your debt ultimately. Wages grew 3.4%. Inflation is running near 4%. So your tenant, the average worker, is getting poorer in real terms, even on a good jobs day. That is collections risk. And a 30-year treasury back near 5% means the agency refinance you penciled in at 4 or 4.5 is gone. And $10 million loan, that gap is $50,000 to $70,000 a year per property in extra debt service. That is the difference between a distribution and a capital call. This is not a number on a screen in Manhattan. Like this is your June that you're about to walk into, the summer that you're in. And here's the first move that you should have. Move number one, your first move is a mindset shift more than a task. If the way you think about this market still leans on rates coming down to bail you out, let that go. I've been talking about that for weeks. That story died on Friday. Get comfortable with higher for longer as the base case, and honestly, get a little excited about it because forced sellers are about to hand you better entry points than you had seen in years. The operators who win this stretch are not the ones with the prettiest forecasts. They're the ones who already decided they are buyers when everyone else is selling. So just get honest with yourself on one question this week. If a great deal landed on your desk in the next 90 days, can you actually move on it? Do you have the cash and the clarity to say yes fast? If the answer is no, then right there is your work. Now, the second story, let's talk about the rocket sucking the air out of the room. The past week, SpaceX priced its IPO $135 a share, around $75 billion raised, and at a valuation of $1.77 trillion. It starts trading on the NASDAQ this Friday, June 12th. That's what, 3 days, 2 days? 1.77 trillion. That would instantly make SpaceX the 7th largest company in the United States, bigger than Tesla, and Elon keeps over 82% of the voting control. So he's selling you the upside and keeping the steering wheel, so gets to do whatever he wants. And it's not alone, right? Like Anthropic, the AI lab, filed to go public on June 1st at a $965 billion valuation. A quick continuity note here, because I want to keep this honest. Last week, I told you that Anthropic was closing around near $900 billion. This week, it's official and it's bigger. $65 billion raised at $965 billion. Revenue run rates crossed $47 billion, and they're on track for their first ever operating profitable year. Around $559 million this quarter in profit. The number moved up and then they filed. OpenAI is right behind them, reportedly doing around $2 billion a month in revenue. Now enterprise north of 40% of the mix. So these are not three speculative moonshots floating on hope. They're real revenue machines hitting the public market at the same moment. Add SpaceX, Anthropic, and OpenAI together, and you have around $3.6 trillion of value hitting the public market. For context, the entire United States IPO market last year was about $45 billion for the whole year. These three are 80 times that at once. So here's what that means for you, and it cuts two ways. The good side, a reopening IPO window at the top thaws everything below it. The LPs have a name for this freeze, and it's called the DPI problem, distribution to paid in capital. The money went in and nothing came back out for 3 years. This is their first crack of daylight, and the stay private forever excuse just died with it. The threat side, the same week your LP saw the SpaceX roadshow, every wealth advisor in the country got a new pitch script. Buy the rocket, buy the AI IPO, get in before it pops. That's the direct competition for the same dollar that goes into your fund. Your LP read that pitch before they read yours. And there's a quieter angle that hits how you actually should run your firm. With Anthropic and OpenAI both becoming public companies, the AI model that you built your operations on is about to be a public company product roadmap, run by a board, answerable to shareholders. If your whole firm is quietly wired into one of these vendors, you just inherited a dependency you never voted on. This is exactly why we built our fractional chief AI officer program for. We plug in, we pick the stack, we build the workflow, and we make sure you're not married to one lab's roadmap right as they go public. When your vendors are ringing the opening bell, vendor strategy stops being optional. Now, here's the second move for you. The people who back you are going to bring up these IPOs. Count on it. So move number 2 is just being ready to talk about it like a normal person instead of getting caught flat-footed. And the honest answer is quite simple. Buying the rocket at $1.7 trillion is a bet that pays you nothing until you sell it to the next person, and you're showing up as the late money. What you do is the opposite, and it's not tied to chip cycles or rocket launches. You don't need a slick rebuttal for that. You just need to be able to say it out loud naturally when it comes up over coffee or people asking about it. So this week, practice it a few times until it sounds like you. Because at the end of the day, what's wild is SpaceX lost $700 million and they're selling at like an 880x or 800x or something crazy. They're trying to IPO at when they're not even profitable. And money got in a long time ago that is going to make money on this. Going in now is not going to make money on this. Story number 3, and this one is wild because it reaches into the retirement account of almost everyone that's going to be listening to this. When a company that this big goes public, it gets added to the major stock indexes, the S&P, the NASDAQ 100. And here's the part most people never think about. Index funds are the backbone of almost every 401k in America. When SpaceX joins the index, every index fund is forced to buy it automatically, whether the fund manager thinks it's $1.7 trillion valuation is smart or not, like you're forced to buy it. Fortune reported it very plainly this week. They said SpaceX and Anthropic are about to go public, and your 401k may be forced to buy in. The index providers are literally changing the rules on how these stocks get added, specifically to make room for them. So read that again. Your retirement account is about to be a forced buyer of an unprofitable rocket company at the single highest valuation in history. Nobody asked you. The index just does it. And the appetite is very real. A smaller AI chip company, Cerebras, just went public this same stretch and popped 68% day one. The hunger for anything AI is just absolutely off the charts. And the winners here are concentrated. Google alone is reportedly sitting on something like $280 to $300 billion of paper gains from its Anthropic stake already. So the upside of this whole frenzy flows to a tiny handful of insiders and a forced index. The average person just gets the bill automatically. Inside a retirement account, they never even check. So why am I telling a room full of fund operators or people listening about a 401k mechanics? Is because it is the single best fundraising wedge that you will get all year. And it's the cleanest version of the contrast you sell. Passive, forced, no income, late versus active, chosen, cash flowing, early. And it's the contrast you sell. Passive versus forced. No income and it's late versus active, chosen, cash flowing, and it's early. Like, watch, guys. You gotta stay up with this. Your idea LP has a 401k. That 401k is about to be forced fed a $1 trillion rocket at the top with zero say in the matter and zero cash flow in return. You offer the exact opposite, a choice and income. That contrast is your entire pitch, handed to you by the index fund committee. Here is the move that you do next. And this story is the easiest reason you'll ever have to reconnect with people. And I don't mean with a pitch. The news does the work for you. Most people have no idea their retirement is about to be force-fed this $1 trillion rocket at the top. So just share it. Forward the article. Bring it up the next time you grab a coffee. Share it on your story. Mention it the way you would mention anything wild you read this week. Hey, did you guys see this thing about the 401ks being forced into SpaceX's IPO? Kind of crazy, isn't it? It's actually the opposite of how I think about putting money to work. This is like the whole move that you should be focusing on. And you're not selling anybody anything. You're starting a conversation. They'll genuinely find it interesting. And the contrast between being forced to do something and chosen, like they get to choose what to do with their money, sells itself. That's the third move from this. Now, the fourth story here, while everyone watched the rockets, the cracks showed up in private credit. And this is the story that decides who wins the next fundraising cycle. And we've talked about this for a while because two things happened this week. First, Jamie Dimon, the CEO of JP Morgan, the most powerful banker on Wall Street, he compared this market to 4 different years: 1972, 1986, 2000, and 2007. If you know your history, you know that those four and what they are and what they have in common. Everyone was right before the fall. His words on the exuberance of this is, I quote, "That doesn't give me comfort." He aimed straight at private credit. He warned the covenants are weak, the earnings are stretched, and the marks, the values these funds report to investors have not caught up to the volatility of this year. His line is, when it happens, it will be worse than people expect. And notice, this is the man sitting on $40 to $50 billion of excess capital telling you he is keeping his powder dry when the guy holding the most dry powder on Wall Street says to wait, you should probably wait. And the second thing about this, the timing is also too perfect. Blackstone runs the largest private credit fund on the planet, and it's called BCRED. We talked about it like last week, about $45 billion. This past week, per Blackstone's own filing, investors asked to pull around 10% of the fund in a single quarter, and the fund filled requests up to only 5% at the top. So some investors who asked for their money back did not get any at all, not because anything is broken, but because this is how these semi-liquid funds are built. There is a gate, and this week on the biggest one in the world, the gate did its job. And understand why this is bigger than Blackstone. A whole generation of funds got sold to smaller investors as semi-liquid evergreen funds. These interval funds, the pitch was always get private market returns, but relax and you can pull your money out every quarter. This week, the largest one on earth proved the fine print is real. Quarterly liquidity means quarterly liquidity up to a cap. And the cap binds at the exact moment everyone wants out at once, which is the only moment it matters at the end of the day. That is not a scandal. That's by design, but a lot of LPs are reading that design for the first time this week and really understanding it. And there is a third shoe on this. Lawsuits are being filed against several of these credit funds, alleging the managers misstated their net asset values and were slow to recognize losses. Now, people are worried about, are there legal questions here? The most powerful banker alive says private credit marks are wrong. The biggest fund on earth just gated redemptions, and the lawyers are circling the valuations all in the same week. Private credit is cracking. You probably should run. Here's the contrarian take, though, the one nobody in your feed is going to say. This is the single best fundraising opportunity for an honest operator in a decade. And I mean it. Picture the LP right now. They watch the smart bankers on Wall Street question what's going on. They question these marks. They watch the biggest fund on earth refuse to give everybody their money. They are reading about lawsuits over fake valuations. What does a nervous LP with capital do next? They go hunting for a manager who prices honestly and tells them the truth about liquidity. The exact things the giants are getting punished for this week. Aggressive marks, locked up money, and complicated gates. Those are the things you can do the opposite of and win this money. And I want you to really feel the LP psychology here, because this is the whole game. Trust doesn't move in a straight line. It moves in jumps, usually right after a scare. This week, it's a scare. The LPs who would have ignored your email in April is reading every word of it in June because they just got reminded that the brand name fund is not the safe choice. They assumed it was. That window doesn't stay open long. It closes the second the headlines calm down. So the operators who reached out this week, while the fear is fresh with a message about honesty and liquidity, those are the ones who pick up relationships that took the Giants 10 years to build. So here's another move for you. In a week where the Giants are getting punished for hiding the ball, your move is to do the opposite, out loud. When you talk about what you do, lead with the stuff most people say for last, how you actually value what you own. When someone who can really get their money back in plain language, no fine print. Most operators treat that as the boring part. Right now, it's the most attractive thing about you. So the next time your fund comes up in a conversation, don't open with the returns. Open on how it honestly works and how people get their money out. In a market full of gated funds and lawsuits over fake numbers, the kind of plain honesty is rare enough that it lands like a flex. That is the move that you need to do. Now, let me bring this down to the ground. So those are 4 stories: the jobs report, the liquidity vacuum, the rockets taking off with the IPOs, and private credit. Now, let me take you where the actual buildings are, down to the courthouse steps, because the repricing of paper just became the repricing of dirt. Here's the 5th story. For 3 years, we talked about a commercial real estate maturity wall like it was a spreadsheet. This week, it became an auction calendar. Texas, June foreclosure auctions, $1.3 billion of loans were flagged to hit the block this month. The highest on record since the tracking started of this. 48 separate loans, 30 of them in Dallas-Fort Worth metro alone. And the biggest category in the pile is apartments, multifamily, the exact asset class most of you operate in. And it's not just garden apartments. The Line, Austin, a 428-room luxury hotel got handed straight back to its lender, JP Morgan, who bid the full $172 million that it was owed, partially because they always place the first bid at auctions. But the owner just gave back the keys. Down the street, the Hyatt Centric sold at auctioned for about 40% off the loan balance. And one of the largest owners on the planet, Brookfield, is winding down its entire Washington, D.C. office business. The one DC building they were tied to just got appraised at $550,000. It was valued at $18.1 million, a 97% collapse on one building. And the data backs the antidotes. Credit IQ now puts office distress around 17%. And per MSCI, there is around $930 billion of commercial real estate debt maturing this year, with about 60% of all apartment loans coming due in the second half of 2026. Now, here's the nuance to this. The smart money is watching, and it's good news for you. Distressed sales still are not surging the way they did after 2008. Back then, distress hit about 20% of all sales. Right now, it's closer to 3%. Great, not that close. Why the gap? It's because debt funds are quietly stepping in and absorbing the trouble before it ever reaches the public fire sale. The translation to this is the best deals are not on the courthouse steps where everyone can see them. They're getting done quietly in private by operators who have the relationship and the capital ready. That's the table you want to sit at. So the supply of distress deals is not coming. It's here. It's on the courthouse calendar for this month, and the private deal desk is coming right behind it. And here's the capital side, because this is where you come in. Real estate fundraising actually recovered last year. It really did. It may not seem like it, but it did. Around $172 billion went into private real estate funds, and almost 90% of it went into one thing: opportunistic value add and distress strategies. The LP money that is moving straight towards this distress. The deals and the dollars that are arriving in the same places at the same time. Your job is to be the bridge. Now, the discounts in private deal rooms are even better than these public headlines, because a bank would rather take 40 to 50% off in one clean motion than carry a bad loan through 2 more quarters of audit committees. Here's that move for you. Here's the move for you based on that. First, get crystal clear on what you would actually buy, not a formal document. Just know your answer cold. What metros, what kind of asset, how big of a discount gets you interested? How long would you hold? Because when a broker or a bank calls about a distressed deal, the operator who can say yes or no in 10 seconds gets it. The one who needs 2 weeks to figure out their own criteria doesn't. The second thing is, this record foreclosure month is a great, no pressure reason to check in with the people who back you. Not a pitch, just a casual, hey, that distress we keep talking about, it's actually showing up. I'm watching it closely, and I want to bring something real when I find it. That statement alone keeps you top of mind for when the deal lands without asking anybody for a thing. Now on to the lightning news round here. Number one, the AI build out went sovereign and it went physical. This week, NVIDIA announced gigawatt scale national AI infrastructure deals in South Korea with Naver, SK Telecom, and Hyundai, who alone are putting about $6.5 billion into an AI valley, is what they call it. And to power it, they're bringing a small nuclear reactors and gas turbines. This is the lesson. The constraint on AI is no longer just chips. It's power and it's land. That is a real estate story wearing an AI costume. Every one of these gigawatt sites needs a substation, a cooling system, and acres of land sitting next to cheap power. Somebody owns that land. In this cycle, that somebody should be a fund. Korea is the template this week. The Gulf of America is next. And if you touch energy, land, or data center infrastructure, start mapping power adjacent parcels in your metro now, because that land is opening before most operators even know it exists. Quick story number 2, free AI is about to get a lot more expensive real quick. Now, this story was going viral this week, and it's because with Anthropic and OpenAI racing to become profitable public companies, the era of cheap and free AI is ending. They have to make money now. For your firm, that means the AI tools you run are about to raise prices. Lock in your stack and your pricing while you still can, because the subsidized phase is closing quick. Number 3, a welder becoming a millionaire from SpaceX equity is incredible. This is the promise of what technology and manufacturing can do for everyday Americans. End quote. Why does this matter for you? Is because equity does change lives. The people who got rich this week were not the traders. They were the early employees who held a piece of the machine. Remember that when we get to the close, because number 4, Wall Street's plumbing went on chain. Franklin Templeton, a $1.7 trillion asset manager, wired its tokenized money market fund directly to stablecoins this week through a platform called MoonPay. In plain English, you can now move cash in and out of a real yield-bearing fund on a blockchain 24/7. This is the exact rail you will use in a couple of years to tokenize the LP interest in your own fund. Fractional, liquid, always on. Imagine telling an LP their stake in your deal is liquid on a screen, transferable in minutes instead of locked up for 7 years. That is the fundraising advantage, not a tech demo that's happening. Learn it before your LPs ask why you don't offer it. Now, I will be honest, I'm really trying to get this into fund flow and seeing if we can integrate this tech and be one of the first platforms to have this type of thing into alternative real estate assets. I think that would be very, very cool. Number 5, this one kind of is a little bit of a homework with a deadline. The SEC is raising the qualified client threshold effective June 29th. To charge a performance fee or carry, your investors now generally need a net worth of $2.7 million, not counting their home, or $1.4 million invested with you. If you run a 3C1 fund and you charge a carry, your subscription documents need to reflect those new numbers in about 3 weeks. So call your fund attorney Monday, today, tomorrow, whatever, not after the FOMC on Monday. Quick hit number 6, Bitcoin hit a 2026 low this week, down to the high 50,000s with the record weekly outflows from the Bitcoin funds, around $3.4 billion pulled in a single week, which is also interesting though, because Michael Saylor just bought, I think, like $122 million in Bitcoin. One headline asked if Kevin Warsh is now Bitcoin's biggest problem. The answer is basically yes. When the Fed pivots from cuts to hikes, the riskiest assets bleed first. And if any of your investors are heavy in crypto, their paper wealth just shrank, and that affects what they can commit to you. So before you ask your LP for a check this month, know where their money is parked. The investor who looked liquid in April might be licking his wounds here in June. Read the room before you call. Number 7, mortgage rates eased slightly to about 6.5% on the 30-year, but honestly, don't get excited. Analysts expect rates to sit in the 6 to 6.5 range for years. This is the new normal, not a dip to wait out. Underwrite your deals to a 6 and 6.5% world and a refinance that never comes to the rescue, which the last story ties the entire episode together. That's number 6. Let me tell you about a deal, and then let me tell you what to build instead. There's a Houston syndicator named Natia Capital. Well-known operator. This week, they were facing foreclosure on 3 North Texas apartment properties. 847 units, about $70 million in debt. Here's the gut punch. Roughly 1 year ago, this same operator closed a $700 million refinance across 18 of their properties, a $700 million refinance. That was a headline. That was the we made it moment. And 1 year later, 847 units are headed to the auction block right now. A $700 million refinance did not save the deal because a refinance never fixes a broken deal. It just reschedules the funeral. And this is the lesson that ties this entire episode together. Nydia did not have a financing problem. They had a structure problem. They were doing deals, deal, refinance, deal. What they did not build was a machine that survives a bad year, which brings me to the most important conversation in finance this week. This past week, Bill Ackman went on the All In podcast, which I love, and you guys know that. Ackman runs Pershing Square, he's one of the greatest investors of this generation, and he laid out 3 ideas. I actually really love this episode, and these ideas were the exact antidote to this story, to Nitia's story. So write these down. Idea 1, underwrite the moat, not the turnaround. Ackman said his whole edge shifted. He stopped being the activist who buys in and fights for a fix and started owning founder-led businesses with a durable structural advantage and just holding. Quality compounds. Agitation does not. For you, that means stop underwriting the deal, the cap rate, the rent bump, the exit. Start underwriting the moat, the thing that is still an advantage 10 years from now. Nitya underwrote deals. They did not own a moat. Idea number 2, stress test everything against a 5-person AI team. Ackman called assessing AI risk the hardest part of investing today because there's now unlimited compute, capital, and talent available to a tiny team that could attack the thing that makes your business special. So ask it honestly. If 5 people with AI came after my edge, my deal flow, my underwriting, my investor relationships, how exposed am I? If your only edge is that you're a little bit faster or you know a few brokers, then a machine just ate that away. By the way, this is the exact question our fractional chief AI officer program exists to answer. So if you don't know where to start, that is the program for you. We can build it out for you. We can help you. Idea number 3, this is the close to this all. Build the compounder, not the deal. Ackman is taking a company called Howard Hughes and openly turning it into what he calls Berkshire 2.0. Real estate plus insurance float stacked into a machine that compounds for decades. He is not doing the deal, he is building an engine. The deal is a transaction. The compounder is a machine, and the machine is the product. Remember the welder from the lightning round that I talked about, the one who became a millionaire? He did not get rich on a trade. He got rich owning a piece of a machine that compounded. That is the whole game. This is the entire philosophy fund founder formula, and that what we teach is built around. We're not teaching people to close one fund and high five, great job. We're teaching people to build the compounding machine. The firm that closes funds for 20 years has a long arc on it, not just one deal. If that frame is landing for you, check out Fund Founders. You can go to wearefundfounders.com and we'd love to be able to take care of you. Or DM me the word funds and I'll send you a free 101 course on funds. And let me make the machine concrete, because it is easy to nod at the hard picture. For a real estate fund, the machine is 3 things working together. 1, a repeatable acquisition engine, a defined buy box, and a deal flow source that brings you the same kind of deal over and over. So you're not reinventing the thesis every quarter. Second thing it does is reoccurring revenue that exists whether or not you buy a single new property this year. Asset management fees, a property management arm, a servicing income stream, some of those things. And the third one is an investor base that re-ups, who roll from fund 1 into fund 2 into fund 3 because you built trust, not because you ran a new ad. And if you have those 3, you have a machine. If every dollar you make depends on closing the next deal, you have a job that happens to evolve into real estate. Nitya had a job. Ackman is moving a machine. Here's the 6th move of this episode, and this is the most important one. Sit down this week, 1 paragraph, answer 1 question. What is the compounding machine inside of your firm? Not the next deal, not the next raise, the machine. The thing that gets more valuable every year, whether or not any single deal comes out. Then stress test it. If a 5-person AI team can come after it, does it survive? And then re-underwrite your current portfolio to the world we actually live in. 6.5% rates and no rescue refi. That's the exact thing that just took down Nitya. If you can write that paragraph, you know what to build. If you cannot write it yet, that's not a failure. That's your entire to-do list for the next 12 months. Here you go. I hand it to you for free. That is the playbook. Before I let you go, let me hand you the whole episode in one list. 6 stories, 6 moves. Screenshot this, whatever. Move number 1, go ahead and just drop the rates are coming down story for good. Decide you're a buyer when everyone else is forced to sell, and make sure you can actually move fast if a great deal showed up. Move number 2, get ready to talk about the IPOs naturally. What you do pays you while you hold, and your people are early, not late. Practice it until it sounds like you. Move number 3, use the 401k story as a casual reason to reconnect. Share it. Don't pitch it. The contrast sells itself, honestly. Number 4, lead with honesty. Talk openly about how you value things and how people get their money out. The exact things that the giants are hiding right now, you have transparency on. Number 5, know cold what you would buy so you can say yes in 10 seconds. And let people who back you know you are watching this distress for them that's in the market. Number 6, write the 1 paragraph. What is the compounding machine inside of your firm? Then go and build it. 6 moves, 1 week. That is how you turn a market that fell apart into the year you pulled ahead. Now, I have a quick favor to ask of you. If you've been enjoying the show, there's one simple way that you can support us, and it's by hitting the follow button or the subscribe button on whatever app you're listening to, because I always want to level up this podcast in every single way possible by bringing a ton of value, bringing incredible content, and guests with new strategies. So following the show, leaving a quick review goes a really long way in helping us to grow and continue to deliver top tier content. If it's the only free thing that I'll ever ask you to do, and it makes a bigger impact than you could possibly understand or know or put into words. So thank you for being a part of the journey, and I'll definitely catch you on the next episode. So as I always like to say, to great success and greater impact. Peace.